Hello, everyone. Today on the final bar, my guest is Sam Stovall from CFRA Research. Talk about the macro environment. And again, always interesting to see how the charts relate to the big picture, the macro inputs, the macro influencers that are causing the charts to evolve as they do. So we'll hear his take on the market. From a technical perspective, we've now had day two of a sort of a downside follow through coming off that key resistance level of the 61.8% retracement level. So what does this mean for stocks going forward? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the markets from a technical perspective, compare the short-term trends, movements, inflection points of today, and try to connect it as much as we can to the long-term trends, the long-term picture, and how that's evolving over time. As I mentioned, today we're going to dig into sort of these last couple days and the potential for this being the beginning of a deeper move down. We talked about this bear market rally for a while now, talked about potential lines in the sand. I think we've hit that last one. And from that moment on, since we hit that 61.8% retracement level, the market's really demonstrated its inability to get above there. We had some great guests recently helping us try to make sense of where things are going. I would say that the consensus response that I've gotten, and certainly resonates with me as a technician, is this bear market rally camp that we've sort of hit the peak, and now we need to retrace to some degree before we can move on to something else. So where we headed next, we're going to try to answer those questions together using the power of StockCharts.com. Before we get there, though, I do want to point out the calendar coming up on StockCharts TV tomorrow. My guest is Tom Bowley from Earnings Beats, a name and a face that I know many of you known from his years hosting Market Watchers Live on this channel. Next week, we have Todd Campbell, Doug Bush on Wednesday, and then Thursday, Kim Sokoloff for the first time on our show. On Monday, also, we have our next episode of Behind the Charts with Matt Lampert. We've had some great conversations at some of the money shows and traders expos earlier in the year, and now, given the situation, given our all work from home status, we're enjoying bringing up some of those conversations and sharing with you some of those really timeless nuggets of wisdom from many talented investors and strategists. So conversation with Matt Lampert coming up next Monday. I also want to remind everyone, we had our latest episode of The Pitch, just recorded it yesterday, just broadcasted it today. It was really, really fun with Aaron Wood from Decision Point and Dan Russo from Chaikin Analytics, and hosted by Grayson Rose. Sorry, I was just told in my ear it airs right after the show, so stay tuned and watch the next episode of The Pitch. It was really, really fun to do, and I think you're really going to enjoy our conversation, wide-ranging, talking about actionable investment ideas. Let's move on to our market recap. So, when I'm thinking of this market, we're going to start actually on a daily chart of the S&P here. Sort of the base case that I've been operating on is the bear market rally thesis, and generally speaking, what that means is you've had a huge sell-off, 30+% down to S&P 2200. You have now had an incredible V-bottom recovery right around the 61.8% retracement level. We've now hit that line a number of times around 29.35. Both times now have come off a little bit. So the S&P putting a lower peak in this week. Other indexes a little higher. So the Qs, for example, making a higher peak this week, but all of them coming off in the last couple of days. And the question now is this the beginning of sort of that next leg down? And I would say, based on what I'm seeing from breadth and everywhere, I think this is about it. I think this is where you'd expect another leg down. And this is where I think there's a lot of differentiation between strategists I've spoken to in terms of what sort of move do we need to see. Is it a short-term pullback and a backing and filling, sort of a sideways trend? That's what some have said. Is this the beginning of a much deeper sell-off to lower lows? That's what Jeff Hughes comes to mind a couple weeks ago, giving a long-term Elliott wave perspective that was relatively negative. Or is this just the next pause that refreshes before we continue higher. Now we're in that seasonally weakest part of the year, May to October, and so the calendar wise, this lines up at right about the point where you'd probably expect some, at the very least, some sort of sideways movement. I think first things first, though, you have to break to a new swing low, and so I think the S&P breaking below 2,800 pushes it below the most recent swing low. That's also the 50% retracement of this overall range. So that would be sort of that next thing. We traded down to it, closed back above it around 2820 on the S&P, and I'd be very interested to see if we get that follow through. If we do, we have then established a lower peak and a lower valley or a lower low. And I think by that definition, the tactical short-term trend is now in a downtrend, and you need to expect weaker prices over stronger. Again, based on the breadth reading that I've seen, that feels about right to me. And when I mention the breadth picture, the chart I have in the back of my mind is this one. This is something we talked about, and they're blurring a little bit. It was yesterday or the day before, I think, on the show. We included this as one of our 3 and 3 charts, and this is looking at the S&P, and then it's the cumulative advanced decline lines for the S&P, the New York Stock Exchange, the mid-cap index, the small cap index. This is not updated yet for today, so this is through yesterday's close so far, but you can see the S&P as of yesterday's close was testing support using a trend line from the March lows. The New York Stock Exchange just closing below it. Mid caps still just a little bit above. Small caps having broken down. So the New York Stock Exchange breadth already broke down through this trend line. The small cap index now broke down through as well. So these have both established now a lower high and now starting to and nearing a lower low. And I think today, when you see these update in the next hour or two, you'll probably see them push a little lower based on the action that we saw today. And that, I think, gives it a little more of a follow through, sort of validates the downside or the potential downside for stocks here, at the very least in the short term. Now, what else do we see looking at the action today? The S&P closed down about 1.7, 1.8% to 2820. Mid caps and small caps down even more. So for the last couple of days, we have certainly seen a rotation away from the speculative, smaller, higher beta companies in general, and more toward favoring the larger, the mega cap names. But again, everything's sort of down today. The NASDAQ 100 down 1.2% to hit a bottom around 9,000 today. The VIX up now to 35 almost. This is up from low 30s, upper 20s not too long ago. In terms of other asset classes, bonds actually finished stronger today. So again, it's tough to make a ton of assumptions about that stock bond relationship at times, because one day, especially one day at a time. I think when you look at the ratios, look at the longer term themes, you can make some assessments about where capital might be flowing. But today we actually had stocks down, bonds higher, and that pushed the 10-year yield down about 65 basis points. In terms of commodities as a whole, down, oil down almost 2% in the form of the USO, gold actually up 1%. And if you go down to the industries that led today, very few in the positive, but gold miners and mining stocks, that's things like Freeport-McMoRan and others, were the two that were up 1.8%. So certainly one of a rare bright spot in terms of the intraday performance today. Looking at the 11 S&P sectors, everything down today: utilities, consumer staples, healthcare, real estate at the top. So sort of a safety trade here. So everything down. The things down the least were sort of those higher yielding defensive area of the markets. And healthcare, we had our show, The Pitch, which is airing momentarily. 2 of my 5 picks were in the healthcare sector, and thinking of broader, the broader group of 3 of us, I remember at least one other healthcare name in biotech. So the number of charts that actually look pretty good, relatively speaking, within healthcare. So not surprised to see that toward the top of the list. At the bottom, you had energy leading the way, down almost 4.5%. Financials down 3%, followed by industrials, materials, so sort of the late cyclical leadership. Also financials down, leading the way further down. And when I'm looking at things from a technical perspective, the only short idea I think we talked about on The Pitch was my friend Dan Russo talking about shorting one of the big banks. And I think there's a justification for that based on the relative weakness. And when we talk about the sectors, when you look at something like the XLF, and sorry for sort of jumping around here, but sort of following things as they hit. What concerns me about financials, and again, the XLF is weighted toward the big cap stocks, right? The Bank of America, Citigroup, JP Morgan, Goldman Sachs types of names, the big ones. They all were down pretty big today and breaking down through their most recent swing low. And this is now becoming more and more like a bear flag pattern, which we talked about But once we had that failed breakdown in mid-April and sort of rallied and tested new highs, it felt like, all right, maybe that wasn't a flag. But now all of a sudden we're validating sort of that was a, sort of a bounce, a dead cat bounce of sorts before we continued lower. What's concerning the most about any financial stock I'm looking at, besides something like MSCI or Market Access or S&P Global or some of those, separate parts of finance that are actually doing pretty well, the relative strength on the XLF has been abysmal, and it has not been getting better. And that's even with the bounce, with the sell-off, with the rally. Banks have just been on the losing side of the ledger, and I think that relative strength continues to weaken, especially in the last couple of days, where we've seen that downside follow through with financials at the bottom of the return list on an average day. Last thing, I just want to point out a couple of quick charts. So I mentioned the financials being down. Interesting to note that BlackRock was actually up. This was after a gap down yesterday, breaking below the most recent swing low, actually returning much higher and finishing in a position of strength, with BlackRock up almost 7% today. So it was not a complete wash of all financials. There are always pockets of opportunity within any sector. I was also interested to see a railroad in one of the top 10 scooter gainers today. This is KSU, up 2% again on a down day. So any of these stocks that moved up in the rankings, they're all up on a down day, which is pretty meaningful. Healthcare, HCA, which is one of the larger healthcare providers, really right at that 100 level. We'll finish with this chart, but I just want to point out, that big round number theory, really there's something to it. And I've studied this and written about this a number of times. A lot of times when a stock hits a big round number like 100, that is a line in the sand mentally for a lot of investors. And if HCA is able to hold here, that's actually pretty powerful if it's able to do it. And the question is this a triple digit stock or not? If it starts breaking down through 100, breaking down through the support, there's certainly further downside. And again, the weight of the overall market, I think, is going to be felt on a lot of charts like HCA attempting to hold above key support levels. That's our market recap for today in a lot of different places, I know, but a lot of interesting themes coming out as the market sort of, right sizes come down a little bit, and we're able to differentiate things a little better. We're going to take a quick commercial break. Back with my guest, Sam Stovall from CFRA. We'll see you in a minute. Hello, everyone. Welcome back to the show, The Final Bar. This is Dave Keller here at StockCharts.com. I want to thank you for joining us. Please keep sending your questions and your feedback. We've loved hearing from a number of you, and we would love to answer one of your questions on our next mailbag segment at the end of this week. So just shoot us an email, thefinalbar@StockCharts.com. No question is out of bounds. We'd love to hear what you're struggling with, what questions you're trying to answer, and we'll try to review those together on the air. Also on Twitter, @FinalBarSCTV is the best way to tag us in a comment and get a hold of us. I want to welcome on my guest, Sam Stovall from CFRA Research. Sam's based in the New York area. We very much enjoyed sitting down with you, Sam, when we came to New York, which feels like a long time ago given everything that's happened, but good to hear you're doing well and good to have you on the show, my friend.
Well, thank you, David. Good to talk to you again.
So, you actually sent a number of talking points. I would love to spend an hour with you digging through some of these. We only have a couple minutes together. Based on what we've seen, right, this bear market rally that I think has surprised many with the severity, this V bottom. Now we're sort of at that point where we've stabilized. This week is pulling back a little bit. What is your toolkit? What is your approach telling you about the current environment here?
Well, it's telling me basically that, yes, we are going through a consolidation, a retest. And the real question is, will the retest be successful? Meaning, will the March 23rd low end up being the low of this bear market? And my feeling is that possibly it will, because of all of the massive fiscal and monetary stimulus that has been injected into the economy. We did not get that in 2008. We did not get that in the 1930s depression, as people keep alluding to. So you really can't fight the Fed with all of the money that is being directed toward this crisis.
You know, it's interesting that you say that, and I think the interesting situation is you almost have this imbalance or this juxtaposition of economic data that seems in some ways very powerful with the Federal Reserve coming in and providing support, but also headwinds with companies trying to reopen. How should investors or how can investors balance those two? You know, I feel like very different inputs right now.
Well, I think I'm a big believer that prices anticipate fundamentals. So by
Mm,
looking at the price action, you can see, yes, everybody is well aware that 2020 is going to be a pretty bad year when you think of economic activity, when you think of earnings growth, et cetera. But it seems as if the market is looking across the valley, looking into 2021, where earnings on large caps are expected to be up 30%, 50% for mid caps, 80% for small caps, even a 50% gain for the developed international stocks. So this year is going to be a kitchen sink year for many companies that just write down everything that they can to make next year look even better.
You know, it's interesting. I remember, I mean, when you and I sat down last, I feel like it was in December, right? It was before the holidays. And obviously the world has changed so much since then. I think it's a great opportunity, though. I mean, I've always found I've learned so much from bear market cycles in terms of just how to approach things. Can you talk just briefly about, you know, since we spoke in December to where the world is now, how do you handle that in terms of your, I mean, things change, conditions change, and you have to adapt to that. You know, what does that do to your ability to model what's coming next and make sense of things? I mean, how much have you had to adapt to this environment?
Well, interesting, but history I always find to be a great guide, but sometimes, like the singer of the national anthem, it forgets the words. So when I think back to the other viruses, SARS, swine flu, MERS, Ebola,
Mm,
Zika, when you look 30 days, 60 days, 90 days out, the market was positive in every one of those observations.
right.
And ditto for COVID-19 1 month after the first reported US case. Then in that 60-day period, the market exhibited the glide path of a crowbar and all bets were off. Yet when you look to investment ideas, a lot of things hold true. One is that worst to first, meaning those three sectors that fell the furthest during the decline, those 10 sub-industries in the S&P 500 that suffered the most, they tend to be the outperformers in the subsequent 6-month period. Another idea is that seasonal rotation. Earlier in this program, you had mentioned that consumer staples and healthcare were doing well. But isn't that interesting? The old adage of sell in May and go where usually says rotate, don't retreat. Go
Mm.
toward healthcare and staples because they tend to rise 3 times as much as what the market does in that 6-month period.
You know, it's a great point there at the end, thinking about sector rotation based on this seasonal pattern that we've seen, right? That in a lot of ways has stood the test of time. Can you comment on how, you know, I think a lot of people are struggling with these feel like unprecedented events, right? Who would have envisioned the coronavirus evolving how it did? Who would have envisioned the fact that we'd all be working from home like we all have now done? And now we're trying to reopen an economy that a lot, you know, again, none of us have had experience trying to actually do. So I think a lot of people are mentally thinking something like seasonal trends, you pretty much need to throw it out the window because you have unprecedented actions. You've got the Fed doing unprecedented things, Congress doing stimulus packages. How do you marry, you know, what you're seeing day to day with the economic data versus cyclical patterns, seasonal patterns that have been so consistent? Are they still part of the thinking at this point, or
Oh,
how should you
absolutely.
incorporate it? Okay.
Absolutely. Because the one thing that has been consistent and constant within every market decline in history is human involvement. So
Mm.
they're naturally going to gravitate toward those areas that hold up the best. Consumer staples, healthcare, demand for the products and services remain static. Or, in other words, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. So basically, those sectors tend to hold up better. And if you lose less on the way down, you have less to make up to get back to break even.
So we only have about 30 seconds left, Sam, but I did want to ask you one final question. I think talking to a lot of strategists a month or two ago, it was much more reasonable that we could expect a retest of the March low, right? Because it was not that far off. Now we've recovered so much beyond there that almost seems like an unrealistic expectation. Do you think there is still a chance of a retest of the March low? And if so, like what sort of probability would you attribute to that as a possibility? Is that still a possibility, or is it something you're not even thinking as an option at this point?
No, I think it's a possibility. I mean, we're less than 2 months away from the March 23rd low. And back in 2008, we rallied 25% from November 20th into early January of '09, only to then turn around and hit an ultimate low March 9th. So we could end up retesting the low. The real question is whether that March 23rd low ends up holding and this becomes a successful retest.
Sam, it is such a pleasure to learn from you and to get a little window into your process. Thank you so much for sharing with us. And I will tell you this, you approach the investing environment with such a sense of calm that I hope our listeners are able to mirror in their own process, because I think you've got a pretty laid back way of phrasing things, which I really appreciate. Sam Stovall, thanks so much for coming on today.
My pleasure.
That was Sam Stovall from CFRA Research based in the New York area, and just a great way of framing things out. Again, as I hope you heard me ask him, I love to think about this relationship between economic data and the challenges that we're seeing with companies dealing with what's happening versus the price data, right? And I think he made a great point, which was the prices reflect, or the prices anticipate what the fundamental data or the other data is going to reflect later. So pay attention to price. That was a really cool set of comments there from Sam Stovall. Our next segment, folks, is called Level Up. And what we love to do is focus on, the tools of the trade, how to actually, hopefully supercharge your use of stock charts to analyze the market environment. And today what I wanted to do is talk to you about ChartList. This is sort of top of mind for me because I've had a lot of time with my colleague Grayson Rose here at the StockCharts headquarters talking about our ChartList feature and just the theory of how Chip Anderson, our founder, sort of set up the StockCharts platform. So what I want to share with you are three things today: how I have my chart lists set up, how you set them up, number two, how you manage them, and number three, how you use them to draw good conclusions about a group of stocks. So our platform is driven by ChartList. So instead of doing a list of tickers like a watch list, you're actually creating a watch list using particular charts. And at times I have, when I first learned stock charts, that felt a little different than things I'd seen in other places, but I've learned to really appreciate the genius of this, because what it does is it focuses on the charts. It doesn't just focus on tickers or data or tables. It focuses on the visual analysis, which I think is really, really important. So step one, how do you manage your chart list? So what you want to do is you want to start going on your dashboard page. And as you go down, yours is going to look a little different than mine probably, but you will have a section called Your Chart List, which is going to have a list of things. You may have a set already on there. You may have a couple example ones that you have set up or that were set up with your login. If you don't have enough on there, if you're looking for ideas, I would tell you this. Go to the very bottom, and I have a bunch of these, sorry, but if you go to the bottom, there's a thing called Manage Chart Packs. There are a bunch of free chart packs that me and others have actually already created. So you can get Arthur Hill's chart pack and many others and actually see how other sort of power users of stock charts have set up their account. You can then take them, copy them in your own account, tweak them, delete them, move them around, but it'll give you a sense of the capabilities of the ChartList system. So that's how I would start it off. If you want to create one, it's actually very easy. You just go to the top, click on New, give it a name, and hit Create New List. And then it's going to give you a couple different options. You can start with just putting tickers in there. And if you just have a couple things to put, that's the best way to do it. Give it a symbol, give it a name. You can put a comment, which is actually great for keeping track of why you're adding certain things. So if you're putting a list of your trades or your brokerage account or a portfolio, it's a great way to actually remember it. You also can put in a series of symbols. One thing that I've noticed people do not pay attention to is from groups. So we actually have a lot of predefined groups already set up. So if you want to dump in all the S&P energy stocks and then look at a chart list of those, we have those lists pre-populated. Just click there. And you'll also see all of our US industries broken down by sector. You can pick them, pop them in there, and then again, manipulate them from there. You can also upload a list of tickers. So if you have them in another platform, if you have them from your brokerage system, download them into Excel. You can upload them right into stock charts and then start to do it from there. So that's how you create a chart list. Now, how do you manage one? Well, so there's different ways to do it. I tend to go to my chart list on the dashboard there in numerical order. And that was an Arthur Hill trick. When I first learned the product, he told me, look, come up with a good numbering system to put your chart list in a certain order. It's all done based on the number, based on the alphabetical listing. So if you just put a series of numbers at the beginning, you can put them in whatever order you want. You can move them around, and it's actually super easy to do. So I have the Mindful Investor Live chart list, which I know many of you have reviewed. I actually put it right at the top of my list with some exclamation points so that I can very quickly, if I'm looking at a chart and I want to put it in that list, I just say add to chart list, and that's right at the top of the list for me. You also see the final bar 3 and 3 and other ones that I've used pretty often. So that is how you manage the list. I would encourage you to put numbers at the beginning. That way you can always just change the title of one of the chart lists and put things on there. Once you have your chart list, how do you use them? 2 things I will suggest you, maybe 3. We'll see how much time I've given myself here. Number 1, if you view a summary of your chart list, what it's going to do is give you a table of these charts. It automatically is probably going to sort it in scooter ranking, but you can also do it in numerical order here. Scooter ranking is actually pretty good. So now I have the 11 S&P sectors, because that's the list that I have on here, and the S&P 500. That's using our ETF Scooter universe, and it's showing me in order their technical strength, from technology at the 93rd percentile down to financials in the 9th percentile. So I can easily see which sectors are at the top of the list and which are at the bottom of the list. You can also resort by any of these other columns if you just want to see what's up or down. So if you have a list of the Dow industry groups, you can use that as a quick way of seeing what's at the top, what's at the bottom on that, based on some of those different metrics that we're showing you there. The other thing that I do, and you've probably seen me use this a lot, is the candle glance capability. So when you're looking at a chart list, you click on the little drop down. These are all the different things that you can use, and at times I've used every one of these in some way, but I use candle glance charts a lot. I've shown you this recently, but I think when you're looking at like the 11 S&P sectors, it's a really good way of visually understanding how they relate. So you can see that all 11 of these sectors went down from February to March. All 11 of those sectors went back up from mid-March to mid-April. And in the last 3 to 4 weeks, you've now seen them differentiate. You've seen financials, the XLF, break to a new swing low. You've seen technology, which is over here, breaking to a new swing high. You can see something like discretionary sort of sideways in a range. And the ability to look across all of those charts and see which are moving where is actually really, really helpful. One of the other lists I look at a lot is just a chart of the Dow 30 stocks, because it's an easy way of just looking and glancing again through all of these charts and seeing which ones are working, which ones are not. This chart is one that I've set up. And if you look at the bottom here, there's a little note. You can create your own template to use on these candle glance charts. You just need to create a chart style with the name candle glance on it, and it'll automatically bring it into your visualization. If you click there at the bottom of your chart list to learn more, it'll tell you exactly how to do it. It's pretty easy, but allows you to look at whatever chart that you want on your chart list. That is our level up segment, trying to break down the chart list feature on StockCharts.com. We are out of time. We need to move into the 3 and 3 very quickly. Chart number 1 is a chart of India. I actually received this question on social media this week asking about India. When I showed the top gainers yesterday, the INDA was the number 1 ETF out of the group of global ETFs I look at. And the question is, that is an encouraging sign. And the fact that it's up when most things are down certainly is encouraging. What is not encouraging to me, though, is on a closing basis, we traded above the late April high, but then closed back below it. So it really wasn't that momentum follow through you'd want to see to expect the chart to go further. Today, obviously, we've pulled back a little bit. And at this point, pretty clear. You either close above the INDA gets to 28 and higher, which says, yes, we're following through to the upside, continuing this uptrend, or we close below 25.50 or so, which would put it below the low from the first week in May and suggest we're now in a short-term downtrend. That's my take on India. Chart number 2 is the TLT, the long bond ETF. Bond prices were up today while stocks were down. The last 2 days after the TLT broke below its 50-day moving average, the last 2 days have actually gone higher. So we've seen this rotation away from stocks into bonds just in the last couple of days. That is a theme that I think would be really important to follow. And the TLT finding support at its 50 days is certainly one way to start that trend. Finally is the U.S. relative to the world. This ratio has been favoring U.S. for a number of years, and we're just starting to break through its most recent swing low. If that is an evolving pattern, if we get a lower high in that ratio, I think you may want to start considering your weighting on U.S. stocks versus non-U.S. stocks, and look at the U.S. dollar chart as well for some suggestions on where that might head next. Ladies and gentlemen, that's our show for today, the final bar. Thanks for joining us every weekday for this great show, especially thanks to Sam Stovall from CFRA Research for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.